Joining us right now is former Reagan budget director David Stockman. And David, you've been here before during the Reagan years. You were able to pass an incredible tax reform. In that same interview that Treasury Secretary Mnuchin said that the gains will be in jeopardy, he said there's an absolute guarantee that a tax overhaul will be signed into law by the end of this year. Reasonable timetable?
No, he said that about 8 times now. First it was May, then it was August, then it was October. Really, I think the guy is clueless. I think the notion that we're going to have a big tax cut is a pipe dream. They can't pay for it, and we're in a different environment today than we were in 1981. 1981, the debt was only $940 billion. It was 30% of GDP. There was plenty of room to have a giant tax cut that was paid for by borrowing. Today, they have to find pay-fors, loopholes, base broadeners. They can't find any. Even the state and local tax savings, which allegedly was $1.3 trillion over 10 years, is falling by the wayside day by day. So I think they're going to end up with no tax bill, or one that is so modest or so minor that it'll have very little impact on the economy.
So you don't believe Treasury Secretary Mnuchin when he says that growth will happen as a result of lower taxes, and that will partly pay for this?
No, I don't believe that for a minute, because they're not cutting taxes on marginal rates that are high already. We had a 70% marginal rate in 1981. The top rate today is 39.6%. Right. They just said we're going to keep the fourth bracket. We're not cutting it at all.
Mike Murphy.
To clarify, do you believe we need a tax cut and they just can't find the place to get the cut from?
That's a good question.
I absolutely believe we need a payroll tax cut that will take the burden off 160 million payroll taxpayers, particularly in the middle and lower end, that are getting hit for 15.5% employer-employee. That's the job killer.
What about the corporate rate?
The corporate
what
rate
about the pass-through
will be a great. The corporate rate and the pass-through will be a great boon windfall for Wall Street. It is not going to lead to any more jobs or any more growth in the United States, because jobs have gone overseas for lower labor costs. Let me give one example. IBM had 0 employees in India in 1993. It's got 130,000 in India today, more than the U.S., not because of a 5% statutory rate, but because they can hire people to work on,
but the bulk of this reform package is supposed to go towards small business. I mean, you're not saying that small business, the guy who owns the hardware store on Main Street, has employees overseas.
No, I'm saying the corporate rate cut is $2 trillion, going from 35 to 20. The big companies that put the jobs overseas aren't going to bring them back. Everybody who gets more after-tax cash flow.
I'm talking about the smaller companies.
But they're already not paying that tax.
They're not paying that tax. That's
35%.
Right.
So when you're saying it's a windfall, the net effective tax rate is 27% for the S&P 500. They're already, shifting operations to.
I don't think GE paid any tax.
Yeah,
no. I agree with that. IBM's effective tax rate is 11%.
That's exactly
But when
right.
we lower taxes on Walmart, they're not going to make any more stores or hire any more people.
No, they're going to reinvest in their online business and bulk that up because they got to compete against Amazon.
They're going to pay a higher dividend. They're going to buy back more stock. This is just a bonanza for Wall Street, because the corporate tax is paid for by investors. It does not get laid onto labor or anything else.
I want to ask about this, though. The Reagan administration was very good at public messaging and everything that it did. Secretary Mnuchin said this warning to Congress that you could essentially blow up the stock market if you fail to pass taxes. Is that political posturing? Is that a public messaging campaign? What's your perspective on
he's right.
The bigger impact?
He's right, but this whole stock market run-up has been a pipe dream about stimulus and a big tax cut that could never happen.
The votes aren't there. It's not just a pipe dream. Come on, David. We're talking about $5.3 trillion in market value. You're calling that a pipe dream? You think that's just a coincidence?
Yeah, because I was talking to an audience 30 years ago today, and while I was talking, the stock market went down the equivalent of 5,000 Dow points.
That's a totally different moment in time. One of the reasons the stock market is up is because of earnings performance. The earnings story. Earnings were up 14% in the first quarter and 11% in the second quarter.
I would have to say, I really challenge that, because that is only basically the pig coming through the python. Earnings today are no higher than they were in the middle of 2014. 3 years earnings went down because of the deflation, the oil and material deflation. They've come back up. They're back where they were 3 years ago. The stock market is up 45% over the same period.
So when you say that you use those statistics, you're talking broadly. There are specific companies that actually have real growth, that have shown huge growth since 2014. So to say it's a pipe dream and pigs and pythons, like the market is priced where it's priced.
Now,
whether it goes up or it goes down.
The market is totally irrational. The market
but it's not more irrational today than it was 30 years ago or 20 years ago or 10 years ago, right?
We had the Nifty 50. Remember, they traded at high multiples back then. You had Coke trading at 50 times earnings. I mean, this is really the same story.
Sounds like you think this is all a house of cards.
Well, I do, because in the 9 months before the crash 30 years ago, interest rates went up from 7% to 10% in 9 months. It caused a tremendous shock in the market that took a little while to develop.
But interest rates are not going to 10% anytime soon.
No. It doesn't. Relatively speaking, that's a 30% gain, okay? Interest rates are going up today, and they will be for the next year, 2 years, 4 years, because the Fed has told you we're shrinking our balance sheet. We're draining cash. They're doing it right now, starting this month. By a year from now, they'll be draining $600 billion at an annual rate, and that is going to cause yields around the world to rise. The whole market is priced on low yields. It's priced on stock buybacks. It's priced on junk bonds out of control. And all of that is going to shift.
Well, yields are still going to stay
low.
The
Fed can mess this up.
The Fed, they can shock it, but they've telegraphed it well. So we've seen it. Even Janet Yellen said we're not going to get to normalized rates.
She's also said they'll be data dependent.
Yeah, of course.
So they're not just going to raise rates.
But the market has...
they have to raise rates. They have to drain the liquidity. They have to shrink their balance sheet because they're trying to get ready for the next crisis and get their dry powder.
To what do you attribute a 3.1% GDP?
What do I don't think there is any 3.1%.
We got a 3.1% GDP 2 weeks ago.
Well, I mean, for one quarter,
and we got it the quarter before. We got it the earlier revision as well.
The average GDP growth for the last couple of years has been plus or minus 2%.
But we got a 3.1% GDP. I'm just saying. I mean, do you not think things are getting better? Do you not think there's fundamental strength in the backdrop for the
No, I do not. I think we're 100 months into this expansion, the third longest in history. There are headwinds all around the world. Mainly, the central banks are going to go into QT, quantitative tightening, in a sequence over the next 3 or 4 years, fundamentally different than the last 30
years. Yeah, but they're doing that into expanding economies. You're looking at the global GDP going up. So, yes, they can tighten. If they don't tighten, they're not doing their job because the economies are getting more healthy. They have to tighten into that so there's not irrational exuberance as we go back to.
What's your biggest problem with the tax plan?
Where I disagree with you is I don't believe the law of supply and demand has been repealed. And when the central banks are draining cash, that means the demand today to hold all of there's 20 trillion of bonds and other securities in the portfolio of central banks. If they drop that by a few $1 trillion, it'll fundamentally, on the margin, affect the yield. And then the front runners, the smart guys on Wall Street, will say the central banks are selling, they're not buying. I'm going to start selling what they're selling. We're going to get the same phenomena on the down that we had.
So what's your biggest problem with this tax plan?
My biggest problem is that it targets the wrong tax. Today, the income tax is a rich man's levy. Of the $1.5 trillion income tax collected in the most recent year, 4%, 6 million out of 150 million taxpayers paid 60%. So if you're going to cut income taxes, you're cutting taxes for the rich. I don't necessarily object to that, but it isn't possible politically. And so therefore, they got the wrong tax.
But 50% of the people don't pay any tax.
That's right.
And then you got the standard deduction that gone to 12%.
No, they're raising it. If you take someone at the median income, $59,000 a year, with the standard deduction, they're raising taxes in that outline by 38% on that household. So the point is, nobody on the income tax side is going to benefit big except the top, and we don't need it. What we do need is a payroll tax cut for the minimum wage person who's out there there having
when
a
you
couple.
say we don't need it, we've had a 1.5% growth story for the last 8 years. I mean, under 2%. What do you mean we don't need it?
Because we can't afford
the rich pay, the 10% of the top earners pay 80% of the tax.
Yes, and they don't need it because they've had the biggest speculative bonanza in the history of mankind. We have had a boom. We have had a bubble in the stock market like never before. The rich people have gotten all that. If they need incentive to invest, they got incentive coming out.
But he's saying this is a middle class tax.
It isn't. It's a lie.
12%, 25%, 35%.
Yeah, it's a lie. It depends on where they put the brackets. They didn't even say. These people are total fakes. I've never seen anything that was as content-free, as substanceless as this 9-pager that came out. Remember what happened in the Reagan time?
Right.
We put out our plan in February, our tax bill in March. The budget passed in April and May. They were writing the tax bill in June. Reagan signed it August 13th. On September 13th.
Thank you, David. September 13th, David Stockman joining us. We will be right back.